we have commodities, which over a 5-year period has done great. Also like gold, just performing very well right now. You see in this this trend going back to July of 2022. It's been a really good trend. It broke out here at a sharp spike up and dropped back, but then look at that, it's already starting to go back up again. Like I'm still waiting for it to return to this trend, but it has not. You know, I'm waiting for it to break, but maybe this is the end of it because it was such a big run up that it might start like chopping around and then come down. We'll see. But I definitely look at, you know, the inverse of bond yields and commodities or inflation to try to see, you know, when there's going to be a flip. But I still have 20% of my allocation into bonds. I'm sorry, commodities. So still doing good. If it breaks this trend though, starts coming down and it breaks this trend, then I'm gonna have to reduce the position. But to me, that would mean inflation's going away, and I'm not. I do see some inflation metrics coming down, but I don't know if it's going to necessarily go away. I don't know if this is temporary or this is like the new regime we're in where we have either disinflation or deflation. You know, disinflation is just, you know, de-inflating what's already happened, and deflation is just going down before what it normally was. So I don't know where we'll be at, but either way, it looks like we still have inflation. And then bonds. So as I said, I increased my position by 15%. I mean, to 15%. I apologize. So if we look at a 5-year, you know, bonds have been coming down for 5 years. So that's why, like, I've hate bonds so much because they've been doing so bad. But there was kind of this bottoming in October of 2023. Around the same time, gold started performing really well. And so far, since this hasn't gone below this lower high, depending on how you look at it on the chart. So hopefully we kind of bounce maybe in this trend. But at some point, I'm hoping that we get a little momentum in bonds. Obviously, the inverse of being long stocks. So if I look, or commodities. So if I look at, let's see if I can add one on here. 10-year. Oh, US 10. That would be smart. There we go. Actually no. Go back. Not price go. Not new pane. Okay, yeah. I just gotta take it back. So kind of look at commodities as. Which one did I pick? Is that right? US 10Y. My bad. Let me try that again. US 10Y. No R. There we go. There we go. Okay. So kind of look at it. Look in the trend, the 10-year, and then the commodities index being a little correlated at some points, not correlated, but a lot of the let's see, US inflation. Looking at just kind of the trend, how they correlate and decorrelate. I'm thinking, in my mind, like you see this divergence right here. I'm thinking at some point the US 10-year is going to come down, which means commodities are going to be coming down, and that's when bonds are going to rise. So if I look at my ETF, you see a lot of inversion, right? See, look at this inversion. Let me make it alignment, make it easier for everybody. There we go. So the blue line, look at this. Look at this inversion. It's disgusting. Okay. Do it on a 5-year. I'm going to remove this arrow because it's kind of distracting right now. So the blue line is my bond ETF, and this reddish line is the 10-year yield. And you see how they are polar opposites, right? When the blue line's coming down, which is the 10-year yield, the red line's going up, right? The bonds, right? The polar opposites, right? So if I throw in the, let's see, what's the name of it? I'm always going to forget the name. We go TRGF. Throw in the TRJEFF. There you go. Price scale. So you see the purple line and the red line, the 10-year yield, are pretty correlated, right? So as long as commodities are going up and the 10-year yield's going up, that means, inflation's going up and bond rates are going up. But when they come down, that means the bond index will come down. So that's why I'm more into commodities right now, because they've been going up. But when it flips, hopefully, if yields are coming down with commodities, if they're coming down with inflation, that means my bond position in this blue here will be going up. But as of right now, you just see this inverse. So this blue line is inverse of the red and purple. So blue line coming down, my bonds, red and purple, inflation and rates going up. Then my bond position going up, my blue line over here going up, some bonds going up, and then inflation and rates, or commodities and rates, going down. And then inverse, 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 right? So if rates go down, that would likely mean inflation's going down and the price of commodities is going down. So with my current position in USCI, I would probably reduce that, maybe from 20% to 15%, just to kind of see what happens. And I may take that 5% and increase it to bonds, because if inflation is going down, commodities are going to be going down, as well as the yield, 10-year yield is going to be going down. So I'm going to want to increase my bond position. But like I said, I don't think inflation is going away, at least not yet, which means interest rates are going to remain higher, which means typically holding bonds is not going to be as good a position, because the value of the bond's going down. The interest rates on it's higher, so your payments, whether they're monthly, quarterly, or whatever you're getting on your bond, the payments are higher, but the value of your bond's going down. Since I primarily use these as ETF investments, I invest in the bond as the ETF itself, so the price appreciation, not so much the yield on that bond. It's nice to have that yield on that bond, because I do get a little bit of those payments. I get those dividend payments, but primarily I'm looking for bond price appreciation. So we'll see what happens. Like I said, as you can see, the purple and red commodities and rates going up, so bonds going down. So I don't know when the turn will happen. It will, I believe, inevitably happen. I don't know by how much, like a lot or a little, but these will start coming down, which means my bond position will start coming up. So I'm just kind of like trying to time that, but timing the market's always like impossible, unless you're like super amazing tech, like investor or whatever. But that's kind of like what I'm looking for on the bonds and commodities, the difference between them. One's up, one's down, one's up, one's down. So if there's ever a turn and these flip, that means my bond position hopefully is going to be doing better.